Welcome back to the deep dive. We cut through the noise, bringing you the core insights from documents that matter. Today, we're hopping in the time machine destination, 1999. We're going to unpack the shareholder letter from the Markel Group. We've got key excerpts from that original 99 letter, plus some questions we've put together to really, pull out the most valuable stuff. Our mission for you today, to get a handle on Markel's performance back then, understand their, let's say, unique philosophy during a pretty wild economic year, and see what timeless lessons pop out for any investor or just curious mind. I mean, think about 1999. The internet boom was absolutely roaring. Y2K panic was looming. The market was just buzzing. But Markel, seems like they were marching to a very different beat. So what can that tell us? Let's dig in.
Okay, so kicking things off, what was Markel's general take on 1999? The letter calls it a very good overall year. They highlight exceptionally good core underwriting results. But, and this is interesting, they also mentioned dealing with difficult market conditions.
Yeah. How do those two fit together? What does that tell us right off the bat about their approach?
Well, that contrast is immediately striking, isn't it?
Yeah.
Markel isn't just throwing numbers out. They're framing their success within the context of the challenges. That suggests a company that isn't just riding a wave to get exceptionally good underwriting when conditions are difficult. Well, that points to some deep operational strength.
Discipline.
Exactly. Real discipline. It sort of sets the stage for a company that often moves counter to the market cycle.
Right. So it's how they did it, not just that they did it. And the numbers, they do back it up. Book value per share was up 11% to $68.59. And get this. Over the 5 years before that, they'd managed a compound growth rate in book value of 22% a year.
That's strong. Very strong.
Revenues grew 23% to $524 million. Net investment income also up 23% to $88 million, boosted quite a bit by the Griffin acquisition. Which brings us to the strategic side. 99 was big for them acquiring and merging Griffin Re and agreeing to buy Terra Nova Bermuda Holdings. So growth, big acquisitions, and navigating tricky conditions. Sounds like a packed year.
It really was. And those financials, especially that consistent book value growth, they really show a steady hand at the tiller. The acquisitions, too, they weren't just random expansion. It seems more like strategically boosting their capabilities during a tough period. That says a lot about long-term vision over, short-term grabs.
Okay, let's drill down into the engine room then, the insurance operations. Given those difficult market conditions, how did they actually talk about their underwriting discipline and results?
Well, the letter's pretty proud about it. It highlights outstanding underwriting performance from their main insurance units. And they back it up with a really impressive number, a 96% combined ratio.
Yeah, 96%.
Yeah, and for anyone listening, remember, a combined ratio under 100% means you're making a profit just from the underwriting itself. You're taking in more premiums than you're paying out in claims and costs.
So 96 is very healthy.
Oh, it's excellent. It really points to very tight, disciplined underwriting.
And they actually called out specific parts of the business doing well.
Did. They mentioned strong performance from excess and surplus lines, evidenced particularly in professional and products liability, and also their brokerage excess and surplus lines.
So it sounds like specialized areas were really firing on all cylinders.
Precisely. This wasn't just, broad generic growth. It was excellence in their specialty niches. And that Griffin acquisition, which closed in April 99, that fed right into this, it brought in significant new premiums in related lines, adding about 26% to acquisition premiums just in the fourth quarter.
So strengthening the core.
Exactly. Enhancing what they were already good at, not really diversifying away from it.
Okay, so with that 96% combined ratio, Markel's clearly profitable on the insurance side. They're taking in more cash than they're paying out immediately. What happens to that extra cash? The premiums they hold before claims are paid, that pool of capital, the float, how does that become a strategic tool for them?
That's absolutely crucial. That float is basically money they hold, often for years before paying claims, and importantly, they don't pay interest on it. The letter really underscores this. They state that a quality balance sheet with a strong loss reserve position is a fundamental principle for them.
Nice.
Their disciplined underwriting makes sure that float is stable and, well, pretty substantial. The strategic advantage then comes from how they invest that float. It's a core part of their model. Think of it as a low-cost, almost free source of capital they can put to work in investments.
So profitable underwriting fuels the investment engine.
That's it. That commitment to underwriting profit and strong reserves, it's the bedrock of their overall financial strength. It's not just about getting bigger. It's about profitable, sustainable growth.
Okay, that stable float naturally leads us to the investment side, which, let's face it, is often a defining feature for Markel. So, given the absolute frenzy of the dot-com boom in 1999, what was their investment philosophy? How did it guide them through that?
Well, they were really consistent. Markel emphasized that they measure success by growth in book value per share over the long term. The focus was squarely on building intrinsic value
Long term.
long term. That perspective is just fundamental to them. And crucially, they defined risk in a very specific way. They said, and I'm quoting loosely here, they do not think about risk in the context of short-term volatility, but rather in the context of a permanent loss of capital.
Permanent loss of capital. That's a very different way to look at risk, isn't it? Especially in a year like 1999 with huge swings.
Totally different. It means they weren't sweating the daily or weekly price movements nearly as much as the potential for a company they invested in to fundamentally impair their capital.
So if they weren't worried about volatility day to day, what were they looking for when they put that float to work in investments?
Their criteria sound pretty straightforward, actually. They aimed to buy shares in companies that showed good returns on capital and were run by honest and talented, shareholder-oriented managers.
So good businesses, good management, not chasing momentum.
Exactly. It wasn't about hot stocks or sectors. It was about the underlying quality of the business and its leadership. And their strategy reflected this conviction. They ran a concentrated equity portfolio. Get this. The top 5 holdings made up 32% of the portfolio,
Wow.
and the top 20 were 71%. That shows they weren't just dipping their toes in. They had real conviction in the companies they picked.
Putting their money where their mouth was. What about the other side, fixed income?
Their fixed income portfolio was managed pretty conservatively. It had a duration of about 4 to 5 years, and the yield had ticked up to 7.1%. So that provided a steady, predictable income stream on a big chunk of their capital, kind of balancing the equity side.
Okay, now here's where the rubber really meets the road for their philosophy in 1999. The market backdrop. Dow Jones up 25%, S&P 500 up 20%, and the NASDAQ up an incredible 86%.
Just staggering numbers.
Right. But Markel, they reported a $1 million net loss from selling investments that year, a huge swing from the $21 million gain they'd realized in 98. Their total return on equity investing for 1999 was actually a loss of 10%, minus 10%, minus 10.
Yeah.
To be that far out of step with the market, especially such a roaring bull market, what does that tell us about their conviction, about how they lived that definition of risk?
I mean, this is maybe the most revealing part of the whole 1999 letter, isn't it? That investment performance. It's not just a data point. It's like living proof of their stated philosophy. To willingly report losses, to underperform so dramatically when, seemingly everyone else was making easy money in tech stocks. That takes incredible discipline. Maybe stubbornness, some would say.
And conviction.
Or conviction, absolutely. It shows they genuinely meant it when they said risk was about permanent loss, not the risk of missing out on a rally that in hindsight had some irrational elements.
Right.
They stuck to their knitting,
Yeah.
even when it made them look, wrong in the short term.
It's hard to even imagine the pressure. Reporting a 10% loss when the NASDAQ is up 86%. If you were a shareholder back then watching your friends get rich quick in tech, how do you stick with that?
That's the million-dollar question, isn't it? It really tests your belief in management's long-term plan and their definition of risk. It's easy to talk about being a long-term investor, but much, much harder when you see that kind of divergence. But, looking back now, those who did stick with it were ultimately rewarded. It just required immense patience.
Okay, so beyond the organic growth and that very distinct investment path, 1999 was also huge for M&A at Markel. Let's talk about Griffin Re and Terra Nova. These were big moves.
Yeah, definitely significant. Griffin Re, that acquisition closed right at the start of the year, January 99. The idea there was mainly to add premium volume and basically complement what Markel was already doing in underwriting. It fit well. Financially, they expected it to bring in about $70 million in gross written premium for 2000. The price tag was $146 million, with most of that allocated to capital, only about $6 million to goodwill.
So a bolt-on strengthening the core insurance?
Pretty much. A deliberate move to beef up the main engine, fitting right in with that underwriting discipline we talked about.
And then Terra Nova. That sounds like it was on a different scale altogether.
Oh, it was. Much bigger. They announced the agreement to buy Terra Nova Bermuda Holdings in August 99. This was a significant specialty property and casualty insurer and reinsurer based in Bermuda and London. big presence in key markets.
Right.
Their business was split across direct insurance, reinsurance, marine, non-marine, quite diverse within specialty lines. Integration started late in the year. The purchase price was around $660 million, half cash, half Markel shares, plus these things called contingent value rights. By year-end 99, Markel figured their total investment in Terra Nova was roughly $865 million.
Wow, those were definitely not small bets, especially in a year with so much else going on. It really shows a company actively trying to shape its future, right? Expanding its reach significantly.
Exactly. And what's interesting is how these moves weren't just about scale for scale's sake. It looks more like deepening their expertise in very specific, specialized areas of insurance and reinsurance. Plus, broadening their geographic footprint, especially getting bigger in crucial markets like London and Bermuda. It just reinforces that long-term commitment to being a major player with deep expertise, bringing in new talent and business lines that fit their model.
Okay, shifting gears slightly. Every great company seems to have its own distinct culture, its own way. What clues does the 1999 letter give us about Markel's identity, its values back then?
Well, one thing that stands out is how they make a point to pay tribute to their underwriters. They specifically praise their exceptionally good performance during those tough market conditions.
Giving credit where it's due.
Right. It signals a real appreciation for their people, their experienced, talented, and motivated staff, as they put it. It shows that expertise, the human capital, is seen as absolutely central to their success, which makes sense in a business like insurance.
And what about the values they looked for outside, like in the companies they were buying?
Good point. They were very explicit about that, too. They stated they believed in buying companies run by honest and talented, shareholder-oriented managers.
Shareholder-oriented.
Yeah. That's not just a casual preference, is it? It reflects their own leadership ethos and a real desire for alignment with anyone they brought into the fold. It speaks volumes about integrity and wanting that shared long-term view.
You know, the tone of the letter itself seems to reflect those values. It feels very direct. It talks about a straightforward and continuous focus on underwriting profits and building intrinsic value. They even say they aim to explain not just what, but why it matters. It feels like they're trying to build trust, talking directly to you, the shareholder, about what makes them tick.
It really is a masterclass in shareholder communication, I think. When you read something like that, you have to ask yourself, do you feel that alignment with their long-term vision? Markel's transparency, explaining the why behind their decisions. That's a powerful lesson, especially in a year like 99, when maybe other companies were tempted to spin things differently to fit the market narrative.
They weren't hiding the ball?
Not at all. They're basically inviting you into their thinking, making you a more informed partner in the journey. Hopefully a more patient one, too, given the investment results that year.
Okay, so we've unpacked quite a lot from Markel in 1999. Let's try and tie it all together. Looking back at this deep dive, what does it all mean for us today? What are the big takeaways?
Well, I think the 1999 letter just paints such a vivid picture of that unique Markel model. Insurance plus investing. It's that powerful loop, isn't it? Disciplined underwriting generates that valuable float.
The low-cost capital.
Exactly. Which they then invest very deliberately for long-term value creation. And that investment approach is anchored by their definition of risk avoiding that permanent loss of capital, not just worrying about short-term market noise.
And their sheer conviction in 99 just jumps off the page. Being willing to lag the market so significantly during the tech mania, it shows an incredible commitment to their specific value investing philosophy. They clearly weren't interested in chasing fads.
Not even a little bit, it seems. And then you have the strategic growth side, Griffin, Terra Nova. It shows they weren't just sitting still defensively. They were proactively, thoughtfully expanding their core strengths and their reach, even while sticking to their principles elsewhere.
You know, people often make the comparison, especially looking back, they ask, was Markel kind of a mini Berkshire Hathaway at this point? Given that focus on book value, the insurance float, the long-term investing,
Wow.
what really stands out to you in this 99 letter that echoes that comparison?
It's a fair comparison. You see why it's made. What really screams Berkshire-like from this letter, I think, is that absolute foundation of disciplined underwriting.
Yeah.
That 96% combined ratio isn't just good, it's fundamental. It ensures the float they generate is genuinely low cost or even profitable float.
Right, underwriting profit plus float.
Exactly. And that frees up the investment side to be truly long-term, patient, without needing investment gains to bail out underwriting losses. And then That willingness to look completely wrong on the investment side in 99, to be so contrarian when the market was euphoric, that's pure value investing DNA. The philosophical alignment is undeniable.
It's that steadfastness, isn't it? That quiet sticking to your guns when everyone else is running in the other direction. That seems to define them. Well, our deep dive into Markel's 1999 shareholder letter has definitely revealed a company carving its own path, committed to long-term value, underwriting discipline, a very particular investment philosophy. Even when the market was singing a very, very different song. So here's a final thought to leave you with. Markel in 1999 chose to significantly underperform, prioritizing their view of risk and long-term value over chasing massive short-term gains. What kind of conviction, what kind of internal fortitude would it take for you to stick to your core principles when the world around you seems to be validating a completely opposite approach? Something to think about. Thanks for joining us for this deep dive. Keep questioning, keep learning, and we'll see you next time.